Today, we're going to dive into one of the biggest yet quietest stories happening in finance right now, what's being called the Great Capital Rotation. We're going to break down why the smart money is on the move, and maybe more importantly, where it's all headed. So let's just start with a number, $2 trillion. That's how much capital just one of the world's biggest asset managers has quietly moved out of the United States. And look, this isn't some guess. This is a massive, calculated shift that's already happened. And that, right there, brings us to the central mystery of this explainer. While most of us, the retail investors, are glued to the headlines and the day-to-day drama, the institutional smart money is silently slipping out the back door. So the big question is, why? This isn't about feelings or patriotism. It's about cold, hard math and probability.
All right, so to answer that why, we really need to look at the clues these big institutions are seeing. Let's dig into the data that's making the once unbeatable U.S. market look, well, a whole lot less attractive these days.
For years, and I mean years, the U.S. was pretty much the only game in town. The mantra was Tina. There is no alternative. But that incredible popularity has actually created a huge problem. The U.S. market has become what's known as an extremely crowded trade. And when everybody is on the same side of the boat, the potential reward for the risk you're taking, it just gets a lot lower.
And the data is already showing this shifts pretty clearly. I mean, look at this. Over the past year, while the S&P 500 grew a respectable 16%, Germany's DAX was up 22%, and Japanese equities absolutely surged by 26%. Big institutions use complex models to get way ahead of these trends because, by the time something is a major headline, the biggest gains are usually long gone.
Okay, so let's talk about a crucial piece of financial plumbing that, frankly, has propped up U.S. markets for decades. It's called the yen carry trade. It's actually pretty simple in theory. Huge investors borrow Japanese yen at almost zero interest. They swap it for dollars, and then they buy higher-yielding U.S. assets like stocks and bonds. It's basically been a giant river of free money flowing right into the U.S. But here's the thing. That game is coming to an end. Japan is finally starting to raise its interest rates. And this move completely changes the math. All of a sudden, the cost of borrowing yen is going up, which means the incentive to even do the carry trade in the first place, it's just disappearing. And this is where it gets really serious. As all those investors unwind these trades, they have to sell their U.S. assets to buy yen to pay back their loans. This creates this huge mechanical, almost automatic selling pressure on U.S. markets. And the result is this really terrifying historical correlation you see right here. When the yen gets stronger, the Nasdaq tends to fall. It's almost like clockwork. Now, I know what you might be thinking. Hey, I keep hearing about the inverted yield curve being this huge recession signal. And yeah, it's been inverted for a while now and nothing catastrophic has happened. Yet. Well, that's because there's a really common misconception about how that signal actually works. So listen, this is the crucial point. Historically, the real danger isn't when the curve inverts. The bear market, the real pain, typically arrives when the curve starts to dis-invert. That's when it starts to steepen back toward its normal shape. And guess what? That is exactly what we are beginning to see happen right now. So if we look beyond those specific signals, institutional models are flagging 4 major systemic risks. These are like deep cracks forming in the very foundation of the financial system. Okay, so first up, U.S. public debt is now over 120% of GDP, and the foreign buyers we've always needed to fund it are getting less and less reliable. Second, market sentiment is just extremely bullish, with almost half of all fund managers reportedly holding zero protection against a drop. Third, Europe is still incredibly vulnerable to energy price spikes. And finally, and this is a big one for anyone outside the U.S., a weakening dollar can completely wipe out any gains you make in U.S. stocks. So, with all of these risks on the table, the obvious question is, where is that $2 trillion and all the capital following it actually going? It's time to follow the money and see where these institutions are finding real opportunity. And it's not just one place, but it's a very clear 3-part strategy. The smart money seems to be rotating into 3 main pillars: hard assets like gold and silver, diversification into undervalued global markets, and the raw materials that are going to power the future economy. Let's start with gold because something huge just happened. Gold was recently reclassified as a Tier 1 liquid asset for banks. Now, what that means is that banks can now hold physical gold and count it at 100% of its value as collateral.
This is a massive structural change that creates a brand new, powerful source of demand for the metal itself.
Next up is diversification. The data is showing some high statistical advantages in very specific international markets. We're talking about places like Italy, Germany, and Japan, which, as we saw, have been outperforming the US, but also emerging markets like India. Even some higher risk plays like Argentina are starting to pop up on the radar.
And that final pillar is strategic metals. The logic here is actually really simple. In a world that's becoming more geopolitically fragmented, the countries and the companies that control the supply of critical raw materials and rare earths, the ingredients for everything from electric vehicles to microchips, well, they're going to hold immense power and pricing leverage.
Which really just leaves us with this final thought. Financial markets have absolutely no memory, and they have zero loyalty. They only reward correct positioning. The time to prepare and adjust is now, when you can move calmly, not when panic is already in the air. So I think the key takeaway from this whole great capital rotation is this. Don't fall in love with any single asset or any single market, but instead follow the data and position yourself for what's coming next.